I do have a funny little anecdote. So, most everybody's seen the movie The Big Short. Less people have probably read the book, but I bought the book and read it well after watching the movie. And the book opens and it's talking about 2002, and it's talking about Household Finance Center, HFC Bank. I got into the mortgage industry in 2002 for Household Finance Center. Like literally the first chapter of the book was like, that was me at that company. And so it was super triggering reading this book because I didn't know. I was like, the year prior, I had gone to work for my uncle who owned a small construction company. And this was right after I got out of college. And we were doing a job down in Vallejo. And I started in November, and I literally was like in a ditch in the rain in Vallejo. And like, he liked to work 7 to 7 every day, 12-hour days. And sometimes we'd work Saturdays. So like, that was my life for like a year right after graduating college. And so after about a year, I was like, what am I doing? I didn't get a college degree to like be digging ditches. And so a roommate that I had was working for this company, and I went to work there, and I was like, oh, 8 hours a day in the air conditioned room. And I'm pretty decent at sales. Like it was like a dream to me. It was the easiest, best job ever. And I was pretty good at it. And so I didn't know any better. I was like, this is the greatest job ever. Like I could do this all day. And so, yeah, that's where my career started, is the opening chapter of the book, The Big Short.
Yeah. And I love the old stories. As somebody who didn't get into mortgage until 2014, I was around. I was a college graduate in 05, and then ran a small business, the Poker Room, right? Yep. And so I've got clients who are real estate agents, clients who are mortgage brokers. I knew enough, right? I got a finance degree. I love numbers. To kind of see what was going on. And right. Funny, side note story. I think you've probably heard this, but I went and applied at AmeriQuest.
Oh yeah.
And part of the, I don't know if it was the application.
That was my second job in the mortgage industry.
I don't know if it was part of the screening process or not. They were basically telling me like, how much are you willing to lie? How much are you willing to cheat? How much are you willing to forge the signature? And when I was, newly graduated from college, so I just spent a year and a half in Mexico, and I was like, listen, I've got business acumen. I've got work ethic. I don't need to cheat. I'll beat all these guys doing things straight up. They were like, no, straight up is not our style. They didn't hire me.
See that? I wonder who you interviewed with, because that wasn't my experience. With time, I saw that was the reality of that place, but it wasn't so blatant when I went to work there. But that's interesting because it totally makes sense. There was a certain element that I could see interviewing you like that. And so I only was there for about 8 months because I was like, I got to get out of this environment. Like,
right. Yeah.
Even being, 24 or 5 years old, I was like, this is not a healthy.
Not it. I'd love to hear from that household finance, up through it. Take me through the different places you worked. It's cool. Stories for me just to kind of hear like how those companies operate. I'm sure 20 years later.
So Household Finance, and there was its sister company was called Beneficial, and they had like brick and mortar retail locations in like strip malls. And it was the most gangster like way of doing business in hindsight I've ever seen. Again, my first job out of school, so I really had no idea, but in hindsight, it was unbelievable. So their business model, basically they would send out checks to everybody in the mail, $5,000 checks. And if the person signed the back of them and deposited them at the bank, it initiated a loan that was like a 35% loan. So these people would get these checks in the mail and they'd be like, oh, cool, $5,000, sign, boom. And then at that point, they're in the system and we can call on them. And so we'd call them and they'd send them out to homeowners, right? And we'd call them and we'd be like, oh, well, we have these third lien products that we, at the time, I still can't believe these things existed. These third lien products would allow you to lend on a person's home up to 125% of the value of the home. It was a third lien. So first, second lien, third lien. And it was also at like 28%, but it was a slightly longer term. So you'd wrap up some of their bills and you'd pay off this gangster loan that they took. And you do that product, or then you'd get the second lien product, which was like a 15-year term. It was at like 15 to 18%. I know, it was crazy. And then you'd wrap that up, or they had their first lien product that was also very subprime. So, at the time, like, prime rates were probably at 6.5. These were at like 7.5, 8.5%. Every product that Household Finance sold had 5 points on it.
Wow.
Every single one. And that was down from the year prior before I got there, when everything had 7.5 points on it.
Wow. Yeah.
It was crazy
Yeah.
in hindsight.
I know. And for context, for somebody who's not in the mortgage industry, when you say 5 points, you mean 5%. So on a $300,000 loan, which, was probably a California loan 20 years ago.
It was like more like 175.
Okay. Yeah.
This was a long time ago.
But still 5% on that, the loan officer is going to make 10 grand on a $200,000 loan.
That wasn't what we were paid though. We were paid peanuts, but that was what the company,
right. The company's
charged.
making 5 points, but now, with competition and the free market, which is a great thing, right? Those spreads have come down to 275, 250, 2.25, depending on what channel you're in.
Yeah.
I love those stories, dude. That's it. What I want to inject here for the average person to hear is anybody who thinks that they're, in the midst of, or we're on the precipice of some big meltdown, some big crash, realize that there was companies that would lend to you based on your stated income 125% of the value. Oh yeah, your house is worth 200. You can do a loan up to 250 grand. What could go wrong?
Right.
17% second. Like, of course these things failed. Of course there was mass foreclosure. And so to think that like we're anywhere near that, knowing what I know about specifically mortgage and finance, all the real estate knowledge I have aside,
Right.
that could never happen again.
Yeah.
And the lending standards are so tight that if there is circumstances where people foreclose, where houses go back to the bank and those things are sold, as REO, it will be such a small fraction of what we saw back then that there's not going to be a flood of inventory. Flood of inventory is what causes prices to come down because supply versus demand. People don't want to hear that, right?